Hey everybody, it's Erik, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts.
You started out as an angel investor. You were sort of investing in your friends that were coming out of PayPal. I'm curious how you were trying to be first check in. I think you were maybe taking board seats, but you're sort of putting rounds together. I don't know if you took board seats. How do you think about sort of how you got started as an angel investor when you got started? How do you compare it to how you might do that if you were doing it, in 2020?
Sure. So, the world of angel investing was very different in like 2003 to 2005 for many reasons. And so I'm not sure, what worked for me would be quite as applicable as it would be today. So first thing was not that many people wanted to be angels. 2003 was still the kind of the byproduct of the nuclear winter in Silicon Valley and the internet bubble exploding. So very few people wanted to invest, either professional VCs or amateur VCs, angels, wanted to invest in new companies. And just by definition, by being interested and willing to invest, you set yourself apart for that era, like 2003 to roughly 2005. And so we became, like me and some of my PayPal colleagues, became like a magnet for people because we're basically the only people writing checks. And so there wasn't really a choice except to come to us. So that's obviously quite different in the landscape today where everybody, you look to your left, you look to your right, everybody's an angel investor, everybody's a solo LP in some fund or something. So that was the easiest part. It was just like, people come to you because they needed money. But once 2005 kind of kicked in, there was a proliferation of angel investments in the beginning of these seed funds. And they were competitive back then, meaning like seed funds were basically substitutes for angels and vice versa. So differentiating is pretty important. The differentiation that I used initially was I'd be a pretty active angel investor, meaning I would effectively take the role of a VC, meaning active support for the company, whether explicitly or implicitly joining a board of directors and hand-holding the founder through the financing process for their Series A, basically setting up key benchmarks that would be important for Series A investors, understanding the Series A investor VC landscape, which the world was less transparent than, what fund was what, who was who. It was very hard to parse. You could search around for all these websites, but they didn't make any sense. So, what's the difference between Mayfield and Sequoia, or who should I meet at benchmark? Helping founders understand that, just as a byproduct of experience, was very, very valuable back then. I'm not sure it would be as valuable right now. So that's how I sort of got to start. And then the important thing as an early angel was to get some traction, meaning to have some perceived to be successful investments, because it does become somewhat self-fulfilling. VCs definitely want to meet companies that you're involved in once they know that you have an eye, sort of eye for the wall and an eye for things that might be interesting. If your first 10 investments aren't very interesting, then when you try to introduce, company X, Y, or Z to VC Y, they're not so interested and they're not immediately responsive. So you kind of have to get some degree of credibility fairly fast because it becomes recursive. Same thing, founders want to go to people that not only they believe will write a check, but that they believe have influence downstream. So it's not this option value investing of I'm going to write 20 checks and then figure this out. And I'm going to, not worry too much about this stuff. I think it kind of backfires. I think it's very hard to have a bad first batch of investments called the first 10, and then all of a sudden start succeeding as an angel investor. In fact, actually, truthfully, all my best investments, unfortunately, embarrassingly enough, three of the five best investments that I ever made were all done in the first year I ever angel invested. So I should have in 2005. I think the original investments in 2005 were the first three were YouTube, Palantir, some other Yelp, and LinkedIn. So it's all downhill from there. So I should have just totally quit and play basketball or something. But the reason why that was possible, though, and it wasn't totally accidental, wasn't totally conscious either, was all of those companies were founded by people I already knew. Every single one of them was founded by a former colleague of mine. So I knew them quite well. So all I was doing is investing in former colleagues and cherry picking to some extent the best of my former colleagues. So I didn't have to know much about business or what companies worked or not. Maybe, some degree of a filter there. But it wasn't like I was suddenly like amazing at assessing random people off the street that were founders and just nailed the first few. It was like every single one of them was a former colleague. Now that led to more people approaching you. And that actually is not necessarily a good thing either, because then there's another problem. When you're not well known as an angel investor or a VC, the people who approach you might be pretty good. Once you get a brand, then you get significant adverse selection. And then you've got to learn how to filter. Like, oh my God, I just got 100 emails. I'm not going to meet, especially as an angel investor. There's no way I'm meeting with 100 founders this week. So I have to narrow. And what I've actually found is the hardest part is actually the narrowing. So my friend Rabois, who runs Sequoia and was our CFO at PayPal, told me this in 2003. He became a VC, and I remember having coffee with him actually 6 months after he started. I said, what's the hardest part of the job? He said, it's deciding who to take a first meeting with. Because everything sort of derives from that. So if you kick people out of your process in the first meeting, you've just lost the opportunity to invest in that company, basically permanently perhaps. And then if you take that first meeting, there's a set of processes and time that goes into that, not just the initial meeting, but diligencing, sharing with the team. It creates a sort of momentum to itself. And I've actually reverse engineered almost all the serious mistakes I've made as an investor, whether as an angel or a professional, is basically at the meeting level of should I take this meeting or not post-meeting. The number of regrets I have post-meeting over roughly 20 years is less than 5. But the number of meetings I should have taken that I was specifically asked to take but didn't and declined that turned into be very successful companies is like this. So, it's maybe not an order of magnitude greater, but close to an order of magnitude greater of mistakes of filtering.
And are there any sort of common mistakes you made when you filtered incorrectly, or any sort of learnings you've had about how to filter better on the first meeting, or what advice would you give there?
Truthfully, I still haven't figured it out, because you cannot take all meetings. Zoom is actually this remote working is making it a little bit easier to take an initial meeting, because in the real world, at least in my experience, it was difficult to schedule a meeting successfully for less than an hour. So any yes basically turned into a minimum viable hour. And therefore, there's only so many of those hours you can commit to. If you're an executive, you have a full-time job and you're angel investing outside, very scarce number of slots per week. So I was pretty strict about only meeting founders, for example, on weekends while I was running things. So there's only so many hours and slots you can make available. As a VC, in theory, you have many more slots, but you also have prior commitments, prior investments, have board seats, one-on-ones with founders, et cetera. So there's only so many hours in a day. And I've not gotten any better, truthfully, at filtering. I'm still thinking I'm making the mistakes on the filter, not on the initial meeting. I probably still, maybe if you hire the right principals, so you can have colleagues, and if you can't take all meetings or can't filter correctly, you can certainly, send them to other people, but then it requires them to have judgment about not missing things. But that kind of can work. If maybe that cuts the mistakes in half, perhaps. We'll see. But I still lose sleep over the times I say no. For example, to be tangible, even though I knew the founders of Airtable well, I declined a meeting on that. I declined a meeting on Coinbase, declined a meeting on Pinterest, or sort of pseudo declined a meeting on Pinterest. That was a little more complicated. There's at least one other very successful company that basically didn't want to meet. And even a couple I got close to declining that I actually wound up taking and actually turned out to be pretty good. So my filter from an email introduction just isn't very strong. But part of it's because I don't know what you're supposed to filter on, truthfully. A lot of great companies are founded by people who are off central casting. And at the end of the day, any filter is going to use some heuristic to decide what to prioritize. But if you decide based upon any historical success, I think you miss maybe the best stuff, many best things. And it's very different than the interviewing process as an executive when you're recruiting employees. I think it's pretty easy to filter LinkedIn resumes. Actually, people who watch me do this, I can take a LinkedIn stack of, used to be printed, but LinkedIn profiles and quickly sort to yes, no, maybe in interviews like this, and with very limited mistakes, because I think you're looking for different things and different signals. But yeah, I still haven't figured this out.
Yeah. And are there certain non-obvious things that you look for in a LinkedIn profile or that rub you the wrong way that people might benefit from?
Yeah, I mean, we're going to blog a little bit more about this or Substack about it, I guess. Cool. But fundamentally, the things you're looking for in a LinkedIn profile are increasing scope of responsibilities. Whether you call them promotions or not, they don't have to be explicit promotions. But people who are ambitious and talented tend to have their scope of responsibilities expanded very rapidly, especially if it's in a dense pool of talent. So if you know what the pool of talent's like so if you're familiar with the company and the caliber of people, and then you see someone accelerating in terms of challenge, responsibilities, titles, that's a really good signal. There's opposite negative signals that are somewhat the inverse, but that's the number one signal. And people who are going to change the world just don't sit around very easily. They get very uncomfortable sitting around. They're not easily pacified. So you can kind of look for that on the founder side. On the employee side, you're looking for also some degree of skill set or experience overlap with your core issues. Right? There's a curriculum sort of training for what are my core problems and what's the right DNA, not necessarily the right exact experience, but what's the right DNA to solve my core problem. And that's different than founders, because of course you can build a company that's really interesting in so many different ways and so many different verticals that you can't really apply that. It's also, as an investor, you want to take more risk than recruiting. I mean, I don't believe in zero defect recruiting where you don't ever have mistakes. I think you're way too cautious, too homogenized, and too conservative if you don't make hiring mistakes. But at the end of the day, as an angel investor, certainly as a VC, you want to have some companies that fail. So you're looking for extreme outliers on the investing side. You're looking for high, let's call a standard deviation outliers, but not the extreme outliers necessarily as executives or individual contributors. So you are looking for further out of the tail for founders, which means you're going to make more mistakes, but that's fine. I just need a batting average. This is baseball. I need to hit 30 to 40%, and then I'm very, very happy by any standard. And if I try to hit 100%, I'm actually going to be very unhappy for the most part. It's really extremely difficult to be both successful and try to have a high win rate as an earlier stage investor, which basically almost all angels are earlier stage investors.
Yeah. And I want to go deeper on the hit rate stuff. I want to talk about sort of overall sort of like portfolio allocation. A lot of people here, people are in different financial positions. They're wondering what percentage of their net worth they should dedicate to angel investing. And then of that amount, how sort of diversified versus concentrated should they be in their angel investing? What advice do you have to sort of both of those questions in terms of like overall, how do you think about sort of wealth allocation and diversification and what percentage angel investment plays relative to other parts? And then let's get into diversification within angel investing.
Yeah, I mean, I guess it depends. Like, people have different goals and ambitions for why they become an angel investor, and they're not just purely financial. Sometimes they're not financial at all. So you can be an angel investor because you want to learn about the world, and one way of learning about the world is getting involved in interesting things, in a very broad sense. And so that may be a non-financial, sort of goal. You may want to propel certain ideas forward. You have, ideological interests. And the world should be more like X. Well, one great way to do that is to help fund it. You may want to propel people forward. There may be people, you think highly of and, want to help boost them. All of these are non-financial objectives. Then there's the financial objective of I want to produce a return for myself. And then on top of that, financial distinct from that one is actually, I might want to do angel investing as either an experiment for myself to see whether I want to be a professional investor, or for developing a track record that convinces other people I should be a professional investor. All of those are very different. And so depending on what my initial goal was, I might, allocate different size checks, think about reserves or non-reserves. There's a bunch of variables there. I mean, when I first started down the path of angel investing, it wasn't designed to make money. I'll put it that way. Like, that was not my goal. My goal was partially to find interesting new companies. And the best way to find them was to get involved really early. And then, maybe I was thinking about doubling down myself, like I would join a company. Exact fact what happened, I went and joined LinkedIn as a byproduct of being an investor. I paid very careful attention to how the company was doing when it was starting tin flack what skills they needed, what was going right, what was going wrong. So partially job search. Secondly, I knew I did want to at some point be a VC. So I was at least thinking about, how would angel investing relate to my ability to secure, a good VC opportunity when I wanted it. I wasn't really thinking this was going to produce money for me when I started. It was only, arguably a minimum 2 years later that it started producing some returns. And I certainly wasn't unhappy about that, but it definitely, I thought of it more as like paying tuition to do all these other things, not necessarily from an ROI standpoint.
Yeah. Let's say hypothetically, just to grill on a little bit, like if some of these people are saying, hey, I'm going to allocate, $500,000 a year, for some people it might be a lot, for some people it might be a little, for angel investing, is like a simple thing, like 10 deals a year, 50K, like, would you not think about it that way? Or how would you sort of recommend that people think about, and this is for the general use case, it's largely financially driven.
Well, again, I do think that you have to be careful that your first X batch does somewhat become self-fulfilling about the quality and caliber of investments. So in a strategy where you're doing, prescribed number per year, that assumes that the first year and second year don't dictate what happens later. And I think they do. I think they're not independent variables. To be strict. And also there's some batching in terms of quality of entrepreneurs and founding companies. There's a bit of this kind of wine vintage thing of like companies founded in 2003, 4, maybe better than set founded in 6 and 7. So you're tapping into a more fertile like crowd sort of. So I wouldn't prescribe per year. I probably would set a budget of over the next, call it 3 years, or whatever my goals are. I want to see, is this working to achieve my goals? So do I enjoy it? Even if you have financial goals in mind, do I enjoy this? Do I like meeting with founders? Do I like the process? Blah, blah, blah. Number two, are there hallmarks that at least on some occasions, my instincts, and that's really what they are right. And that these might turn into interesting companies because measuring 1 or 2 years later isn't going to be like a slam dunk of like guaranteeing financial returns, but you should know whether you're on the right or wrong track. And so you should see a spark of at least, on occasion, I seem to be tapping into some interesting veins and these companies have high potential. And then also, insofar as you have non-financial objectives, like, is this helping me get from point 1 to point 2? So I knew pretty quickly thereafter that I at least spotted this LinkedIn opportunity by being an angel investor. Same thing happened when I invested in YouTube. It became pretty apparent to me that I would be a good fit personally for what the company needed and that the company was going to do phenomenally well. And then if I wanted to jump into like a COO position, there was a great opportunity there. That said, it happened about a year after I joined LinkedIn, so you can't quite switch jobs that fast. So the theory was right about using angel investing as a platform and perspective and periscope into companies for potential full-time roles, but realistically, you can only kind of have one full-time role at a time. So it didn't quite work out the way I sort of forgot about that part when I was planning this strategy. But I would probably just take a budget and let it float over a reasonable amount of time, probably no longer than 3 years, probably not less than 1.
Yeah. Is there an overall Keith Rabois theory of personal wealth allocation?
Yeah, I mean, I follow what investment advisors will call a barbell strategy. It's a little different now as a VC, but while I was executive, so for 13 years, I was an executive in these kind of high growth companies, and while I was angel investing, I followed what I call a barbell strategy, which is basically my job running companies was super high risk. Like I joined PayPal, LinkedIn, Slide, which no one remembers, Square, etc. When there's basically nothing working at those companies, certainly no revenue working, at least no business metrics working. And so that what I did for a living is what I had to explain this to my wealth advisor is super high risk. Like my options are basically worth 0 when I join all these companies. So what I want to do with any wealth I have is preserve it. So put it in the most conservative places possible. Because what I do professionally is designed to create wealth. I don't want like some random Goldman Sachs like investment advisor trying to create wealth for me. And then there's an old blog post that I really liked about this topic that I recently retweeted because he's been doing very well recently, and I really enjoy working with him, by Mike Spicer. So Spicer wrote this great blog post in, I think it's 2007, but plus or minus 2007, about the flaws of diversification. And the basic thesis is actually, it's got some rigorous math behind it, but it's counterintuitive to almost everything most people are taught, which is diversify. And his whole point is if you have asymmetric ability to do X, you should never be diversified. And that was, very instructive to me. It's like, okay, I have asymmetric ability to create companies. I don't want to be diversified at all in that stuff. But I don't have asymmetric ability to trade public equities or municipal bonds. So I want to be very highly diversified and very safe, and then take all my risk on angel investing and other professional endeavors. When you become a VC, a professional VC in a large fund, it's a little bit different because you have a kind of a smoothing function. Like, we vest over at KV like 10 years, and the Founders Fund like 6 years. And we just repeat each fund as a new 3-year cycle. And so if you're successful, the income side kind of, the gains kind of blend in over a very long period of time. So you don't quite have this spiky result, and you have a portfolio. So, in KB, we would typically have 50 to 100 companies in a fund. Founders Fund's a little more concentrated, but call it 30 to 40 companies. So you're kind of creating a smoothing function by definition. So I'm no longer as extreme with, sort of my decisions, but I'm also no longer taking super high risk bets. Like being a VC, being a GP in a fund, large fund, is not a super high risk bet. Like that's not like starting a company at all.
Yep. Totally. So it seems that there's like three paths. There's sort of like start a company or be an exec and angel on the side. Then there's be a full-time VC, and then there's also like be a full-time VC and incubate open door or incubate a company. And a lot of people here are sort of thinking about which of those three paths they should or could potentially do. I'm curious, what do you think separates sort of like people who should be an exec and angel invest versus people who should be a full-time VC versus how do you pull off even the be a full-time VC and incubate on the side? What sort of insight do you have there?
Well, let's start with the two more traditional polls. Let's say, do you want to be an executive and angel invest? That's a skill, discipline, running teams, building things. And if you're proficient at it, it's a great option. Professional investing as a VC is a very different exercise, and there's not that much common between these two things. It's like playing two different sports. Like it's called baseball, basketball. There are a handful of people who've been able to play both at a high level, but they're very, very different. They tap into very different skills, even though they're generally in the same domain, like professional sports, et cetera, entertainment more broadly. Just like Silicon Valley has VCs and entrepreneurs. To be a VC, the things that are most interesting are, if you're intellectually curious, it's the greatest job in the world. Because you basically get paid every day to learn new things about the world. And there's almost no roles left where you get compensated for learning new things. Academia is basically narrow, and journalism, we don't get compensated. So basically, there's nothing left except being a VC if you're intellectually curious. I think it's wonderful, but not everybody's intellectually curious. Many people like to master domains, and that's not what a VC does. Second thing is if you like the role of being almost like a psychologist, it's a great job. So basically, I sit down and work with founders, basically every day, no longer in person as much, but fundamentally sit down and basically say some version of tell me your problems, and then ask a bunch of questions, and it's just repeat. So if you like that kind of dialogue and you think you can advise or counsel people through that kind of dialogue, it's a very good role. If you like to make decisions, it's a terrible role. Like there's very few decisions I make. I'm all I need for, except, do I want to offer a term sheet? That's about the only decision really I make. Versus an executive, you're making decisions basically every day, sometimes every hour. And so it's not an executive brain job. It's very different. So I think most people have a more natural fit in terms of psychological happiness, let alone skill in one of these two areas, and they should choose wisely. And then there's byproducts of that. The stress associated with being a VC is significantly different. Like there's not a lot of short-term stress in this job. There's much more short-term stress disruption to your family, disruption to your vacation, whatever the case may be, versus VCs are more predictable lifestyle and more compatible with certain things. That said, you don't have the ownership mentality. It's never your baby. And so the downside to the lack of stress is it's never mine, and it's never my decision, which leads to predictability and sleeping better. But sometimes people want the adrenaline of the stress and the ownership and having it be their baby. So I think most people should make a decision of which one's more attractive and which one do they think would be better or more beneficial out. There may be some people that can be equally happy, equally talented at both, but I actually think that's more like a corner case than like a common. So I think that would filter basically which one are you better at, which one are you happier at, and do that. If you're now to answer your last caveat to your last or bracket to your question, there are some set of VCs I think would be very good at incubating companies. It's very time consuming. So it's basically going to crowd out a reasonable number of investments. You're going to be less of a diversification, diversified investor, more of a concentrated investor. For some set of people, it can work very, very well, but you have to recognize the trade-off there and say, I have so much conviction about this opportunity that I'm willing to forego all 3, 4, 5 other material investments.
Yeah. Is it fair to say that, like, if being an exec, while angel on the side is like, 90-10 operating to investing, and being a VC, full-time VC is like 100 to 0, investing to operating, that sort of your position is it like 70-30 or 50-50, or how do you sort of like the operating brain, executive brain versus the sort of investing brain pie chart?
I don't think you want to apply almost any of your operating brain as a VC. Where it can be helpful is post-investment, insofar as a founder confronts a set of challenges and wants your advice. It may be the case that you've confronted that problem or set of problems before, and you can walk through the analysis of, here's a conceptual framework of thinking about the trade-offs, or here's what I did and here's what went wrong, so the grass isn't quite greener, or here's the person I would go to for expertise in this particular set of challenges. So the byproduct of having been the operating executive before is you may be able to give better advice and counsel, but that's post-investment. It's probably not that useful for finding new investments, maybe be negative, and it's maybe helpful in closing investments. That's a little bit more debatable. I think there is some preference for founders to work with people who've been successful as founders, executives before, but it's more at the margin. Some of the best investors ever definitely were not, founders or executives. Think Mike Moritz, Peter Fenton as examples, Bill Gurley, all were phenomenally great VCs. So you clearly can be super successful, but it is valuable. It's just you have to find different values to leverage if you haven't had that experience.
Yeah, I want to segue into a couple other topics. First is just the topic of the day. It's the Coinbase post. I'm curious for what you think the significance of that is, what that sort of means for others, or just sort of the industry at large, and just given your context of being operated in companies for the last couple of decades, how you sort of think about it.
Well, I think the key, maybe put it in a different framework, is the key. Erik talks a lot internally and sometimes on the internet about values, and values are only meaningful when they say what you're not going to do. Like, values that everybody is subscribed to are actually completely useless. So the only values that matter when you walk around an office are ones that allow the company to make decisions because they create a filter and a byproduct, a binary sort. So the best thing about something like this is it makes it very clear that if you have certain views about the world and how companies operate, great. There's plenty of companies for you. Don't go to Coinbase. Conversely, people who are frustrated with all of the distractions, I'm trying not to be too biased here, but all the distractions associated with Facebook, Google, et cetera, can go find companies that are, using Brian's terminology, mission-oriented, but basically that aren't going to allow political debates about general societal issues to trump the day-to-day activity. And so that's great, because then you can have self-selection to, what companies are best fit for me, and what companies and what kind of employees do I want. And there are plenty of options for everybody in the world right now. So I think that that's healthy. What's not healthy is when people either feel deceived, like I thought the job would entail this or it wouldn't entail that, and then you kind of have this whiplash experience. But I think it'll be very positive in terms of companies can have their own debates. So we did this at Founders Fund. We have an offsite for CEOs, which we usually do annually, which we obviously didn't do this year. But last September of 2019, we had like this offsite for our CEOs, for many of our CEOs. And we had 2 debates on the first night. Sort of people broke into groups and had debates. And I won't tell you what the second one was because that would be very distracting. But the first debate was about this topic. Should a CEO ever take positions on policy issues that aren't directly related to the core business of the company? And after like an hour debate, you can imagine like the various people that were there debating, it came out to be about 85% in the sort of Coinbase camp, and then a small minority were persuaded. But it was a very active dialogue and debate about it. So I think in any event, I think it's helpful to be clarifying about what your company stands for, what kind of people you want, how do you do your work. Just like there's other dimensions to this that are not politicized. Like, so for example, some companies make decisions on the basis of metrics, and some make them on the basis of, let's say, vision or design. You want to be clear about that because that becomes self-fulfilling, and you don't want to hire bottom-up driven, empirical, numbers-driven decision makers for a company that wants to be design-driven, and vice versa. So I think this is just one dimension to having crisp, powerful values.
Yeah. Are there any other examples that come to mind in your portfolio or otherwise of sort of value of what a company is not doing and is explicit about that could be insightful?
Yeah. Well, I mean, like another very common one are like the culture of perks, right? Like many of our companies do not, in fact, offer lunches. Pre-COVID, but fundamentally, at the end of the day, the Amazon and Apple style, which is you don't get any perks basically, versus the Google, Facebook, feed people, give them perks, toys, etc. You can build, obviously, just by the examples I just used, you can clearly build a large successful company in either of those models. But I think it's important to have a clear view as a founder which one you want to embrace and not switching back and forth. I think there is a lot of pain and sort of unnecessary friction in switching models. I think there are different types of companies that are better suited for one of those 2 models, actually. But fundamentally, I think that's like a value. It's just like we either focus on every last basis point of cost, and if it doesn't improve ROI of the business, we don't spend it unless there's a true business case for this. Or part of our job is keeping employees happy, motivated versus going to other places, and that includes this full compensation package, which includes some of these benefits.
Yeah, no, totally. I mean, segueing a little bit, we're talking about Coinbase. Are you likely to make crypto investments in the next year or 2, or where within crypto are you excited, if at all? And where do you think sort of underhyped or overhyped?
No, at Founders Fund we have a strong Bitcoin maximalist position. So for several funds now, we bought Bitcoin directly, and we've been quite successful with that. And I think that's our current strategy. As for a variety of reasons, we think we can get all the alpha in Bitcoin directly. We think that that's the best investment, and we're open to new things. I mean, founders could pitch us with new ideas. As I said, we're founder-driven, also a founder-driven investor. So if a founder walks in and wants to teach me about the future and they convince us to change our mind, we're open-minded to that. But we have a pretty strong internal hypothesis that has proven to be quite successful so far. So it would take somebody reorienting our brains and into a new paradigm, really.
Yeah. So a couple questions on sort of pricing. One is, where do you think we are in terms of vintage for various investment levels? Are investments too expensive now? And also, how disciplined were you on price as an angel investor versus as a VC? Or how did you approach it differently?
Yeah, it's a very good question. I think partially when I was growing up as an angel, one didn't have to be super disciplined on price because everything was so cheap. When I invested in Airbnb, I think this is public, I think the first money was $3.5 million. And when I invested in, let's say the series A for LinkedIn was at either 10 or 12 posts. So to some extent, because of where the market values were at the time, if you were disciplined or not disciplined, it wouldn't have mattered. When I invested in YouTube, I can't even remember what the price was, but 4 million, maybe we're rolling it in the note into a Series A. Maybe it's like a 12 post, something like that. So, just the market was very different. Right now, I don't know if that would work. There's definitely people who follow the strategy, and I'm going to be very price insensitive. And I'm going to get some big logos associated with me as an angel or even maybe as a VC. And then parlay that into earlier stage companies where I'm more focused on price. So first generation, go out and find the coolest companies I can find, figure out what it takes to be an investor and not worry about it. Set up phase 2, which is I'm going to go really compete now that I have a track record. Most people don't know how to process the logos. And so now I can be much more disciplined and more of a price setter rather than a price taker. It depends a little bit also on the check size, given your financial goals and net worth, truthfully. The smaller the check you write, the harder it is to set price, just by definition, right? Like if you're going to write a $25,000 check, pricing around is probably a fool's errand. So you're kind of in or out in some ways. Someone else is going to set the price, the market, or one bigger investor. Whereas if you're writing, let's say, a 100K check or above, you may actually be able to set the price. And so then being disciplined or thinking about valuations, how much they matter or go, is more of an intellectually interesting exercise. Whereas it's not a practical consideration at 25K check. So it also doesn't matter as much. And you want people to follow you. So even if you're writing, let's say, a 100K check, even if that's only a small fraction of the total round, the perception that people think you know what you're doing in terms of pricing evaluation will allow people to more easily follow your pseudo lead in quotes, basically, without barfing. So one of the features, this was important as I was an angel, let's call it 2007 to 10. If I agree to a price with the founder can then parlay that into a simple yes or no decision from other investors and just saying, Keith agreed to this price. People thought I was credible enough that they may or may not want to invest, but that the pricing was plus or minus good enough. And that was valuable. There's some founders who have used that occasionally. One of my friends who's a founder immediately parlayed my agreement to double his valuation into raising from a bunch of other people without really telling me he was doing that. And I only found out about it 5 years later when he sold the company. So people, occasionally would have fun with using your brand a little bit, but it is important that people believe that the value, you don't want everybody second guessing your valuation to some extent if you're going to pseudo lead and price something. As a VC, it's a massive debate. I started, like everybody does, I think, in the business and sort of thinking price mattered a great deal. I think the way maybe I'll reconcile a couple different views on this is there's probably zones, and they're broad zones, but as long as you're in these zones, the price really doesn't matter. So let's say for a very early stage company, low end 6 million, high end call 20 million, let's say post. If the company is very successful, that zone is going to work out phenomenally well for everybody involved. Then you have the sub 40, maybe these days sub $50 million zone. Then you have another sub 100. The details of where you are in those zones don't change the fundamental economics of risk reward. And I think you can get caught in, I'd be in at 70 posts, but not 80. And that's probably incorrect. Whereas in at 70 posts, but not in at 100 posts, may be a material strategy difference over time. Or in at 50 posts, not 100 posts, definitely has material consequences. So I think the way I now try to think about it is more what's the risk reward equation, and the price, the valuation is giving me more, call it non-empirical indications of the risk reward equation I'm saying yes to.
Yeah.
I actually think a lot more about dollar. Well, this is the difference between maybe KB and Founders Fund. At KB, I would think more about the dollars I was investing. Is a price. So think of it as poker. of each time you invest, you're learning more about the company, about the market, about the founder, and what's the price of each incremental card. And sometimes for one card, you learn a lot. Like in a short period of time, you learn a ton. And then the next card can be a lot of money, but you don't learn that much more. So we would look at it about like information content per dollar. And I think that's a reasonable way to do this. It's somewhat different than valuation. It's just like for this much money, I learned this much information about whether I'm on the right track. And that can be very smart. And we do use that prism, but not as an exclusive prism at Founders Fund, but it's a relevant way to frame, like, should we invest in this round or wait for the next round?
Do you have a take? Do you value ownership more so than you think about multiples, or equally, or one or the other?
As at KV, we thought almost exclusively in terms of ownership. At Founders Fund, we rarely think in terms of ownership. We think much more in terms of dollars.
Yeah. So you've chosen to join, and run two different funds. In 2020, it's easier than ever to start a fund. How do you recommend people think about the trade-offs between starting or joining, a fund in 2020, even if, the one that they start might be, 10x, smaller than the one that they could join or more?
Well, I think there's a couple folders. One is the most important one to me is, do you want to work with other people or not? At the end of the day, the reason why the easiest thing in the world for me would have been to continue to be angel invest and make money. Because once you establish, this kind of recursive loop, it's actually pretty easy to invest in clearly high caliber companies. But I wanted to work with people, and being an angel doesn't allow you to work with people. Like, I wanted colleagues, teammates, and partners. So that just meant, by definition, I was going to go in a different world because I just wouldn't be happy, put aside whether it be like economically successful. Then in the fund size, if you say, okay, I'm going to work with colleagues, I'm going to create an institution to work with people. The difference on funds is like basically your ability to have impact in a company's trajectory. There's this fund size where you may help propel something, but truthfully, you can't really impact the company. You're just not adding enough rocket fuel. So I wanted to think that more often than not, what I did mattered and had consequence, not that I was just a financier. And to do that, I think you need to be able to commit millions of dollars to a company at minimum dose. And as an angel, that's very expensive, especially if you're going to do it every few years, like writing $1 million checks. There's a reason why even the billionaires who do angel investment don't typically write very big checks. It adds up really, really fast if you're writing significant checks constantly, multiple times a year, and the money doesn't come back to you for a decade. So as a fund is a great structure for having influence and being able to propel ideas forward that need a minimum dose of capital. Think like Open Door. So there was no way to validate whether Open Door could be achieved or successfully or not with less than at least $10 million of capital. That was the absolute minimum viable amount. You could try cutting it a billion different ways, but there's just no way to do it for less than $10 million. You could have tried $5 million of equity and $5 million of debt, maybe, but the better way to do it was at least $10 million of equity and at least $10 million of debt. And so there's ideas like that being a professional VC allows you to give people the opportunity to chase their dream. And I wanted to be able to do that. So I think the fund size dictates a little bit how much impact you have and what kinds of impact you can have. And so I wanted to be affiliated with a larger fund where I felt like my conviction alone could give this entrepreneur or this vision a shot. And so that was very important to me. Can you scale a smaller fund into a larger one? Absolutely. Can you recruit people, start as a solo, VC and add people to your team to get that psychological satisfaction? Probably. So I think you can, it's not like they're so binary. There's probably a hybrid strategy where you start one way and evolve into the other. But for me, it's very important to be working with people. I actually wanted to work with partners too. I like having a debate with colleagues about, I think the right colleagues make you sharper. Like I pointed out, some of the failures or missing things. The right colleagues, might have taken some of those meetings, or if I was going to pass on something, maybe they would talk me into it, or vice versa. So I like having some stereos around, even if it's my decision finally what to do. So I wanted to be in a place where that would be true.
Yeah. How do you think about your use of Twitter? Is it sort of And like, what is it? Sort of just like following interest and instincts? Is the idea of like a strategy sort of an oxymoron, or how have you sort of like thought about your use of Twitter?
Well, so I started Twitter originally when I was getting ready to join Square. I was like, oh shit. No, I mean, I had a Twitter account before that, and I used it lightly. One of my engineering managers at Slide was addicted to Twitter when it first launched, and I kind of played around with it a bit because of his like insistence. He's one of those engineering managers who just will never stop. You know, the type of engineering manager I think when they have, you know, a crusade, you're just going to hear about every day until you finally relent. So I finally relented just to shut Tyler up. But in any event, it did, like at Square when we'd hire employees, when Jack would introduce you to the company, he'd have your photo and then your Twitter handle. So it's sort of put a premium on using your Twitter account. I use Twitter for a couple different purposes, actually. So obviously I like to disseminate information about our startups and our founders. I have a reasonable number of people that follow me, and I can help, you know, recruiting, media attention, etc. So just being able to be helpful. Secondly, obviously, like to share information. There's like views about the company and stuff. It's a good broadcast mechanism for that. And that does create some, you know, inbound deal flow. There are definitely people who reach out to me or the Founders Fund because of stuff they've read, either through like, you know, what do I call these, like Solana, or, you know, something about our perspective on the world. We have sort of a brand, and we want to use channels to communicate the brand. Third, though, that's different, and it didn't really happen until probably, I don't know, I passed at least 20,000 followers, maybe 50,000. I was like, look, I have this platform, I have an audience, there's things I believe about the world. I feel like I'm negligent as a citizen of the world if I don't use my audience to proselytize on occasion. And maybe I proselytize too much sometimes. So it's like, how much is it like business related versus proselytization? And, you know, I used to tweet a lot about sports, and that would drive a lot of people crazy, but it would thrill people. I once did this poll where it's like, what mix going into 1 year, like I did one of those polls going into the new year on January 1st, like what mix of sports, politics, and like, you know, startup stuff do you want? And it was like roughly a third, a third, a third. But, you know, like the sports stuff I've toned down a bit because I definitely, you know, I had a loyal 10, 15% audience of sports followers, but it would just infuriate the Patrick Collisons of the world. You know, like John and Patrick would be like, oh my God, here comes sports ball again.
Amazing.
So you don't see that many, I'm pretty rare on the sports content these days.
Yeah. One thing I appreciate about your Twitter that I don't have the courage to do is to correct people.
Yeah. So I took on this project of like, certainly didn't do this while I was running a company, but for the most part, I would correct things that were false or defamatory about Square across Square. Because there'd be people who were always critical of the company, and I was just like, no, you're not getting away with this. There's no reason we should allow you to tweet false things about the company. Because that stuff becomes somewhat self-fulfilling, right? Like other people read it, they Google it, and journalists read it, and people just assume it's true. So it's like, no, we're going to correct. I read every tweet about Square every day. And so I responded to some if I felt they were incorrect. But anyway, I took on the bigger fool's errand as a VC of trying to correct everything on the internet that's wrong. It's like talking about being insane. There's so many wrong things. That was like just a crazy idea. So I think I'm gonna stop like trying to correct everything that's wrong on the internet. I might sleep better at night. That's what I mentioned over the weekend. I'm gonna start publishing more on Substack. Yeah. Trying some long form stuff just to sort of focus my energies on something, you know, more positive perhaps, and not try to correct every fool on the internet. There's like a lot of fools on the internet. So it's like chasing, you know, it's like one of those, what do you call those things where the mouse runs in the treadmill? I feel like I'm doing that way too long, so I probably should stop doing that.
Yeah. There's the, I don't know if you've seen the comic, the Are You Coming to Bed comic. He's like, I can't, this is important because someone's wrong on the internet. I gotta correct it.
That's like my life. It's been like for the last 7 years. So I think I'm sick of running up the treadmill. I gotta run on a real treadmill.
Yeah, well, I appreciate it if it's for health reasons, but know that it's thoroughly appreciated. Someone's got to correct people. Someone's got to do the dirty work. So maybe someone else will.
I'll leave it to Delhi. I'll leave Delhi and
exactly.
correcting everybody on the internet.
Yeah, exactly. I mean, it is interesting just to talk about like PR strategy for a second, because your colleague and longtime coworker and friend Peter Thiel doesn't correct anything about him on the internet, and there's all these sort of dumb sort of accusations, and it's just interesting as a counter.
Yeah, it's interesting. I think Peter. Well, yeah, he just basically shuts down the the organizations that publish the defamatory stuff.
Yeah.
It's probably a more effective strategy than mine, truthfully, but it works for him pretty well. So I'm not sure I'd recommend that for everybody. But in any event, yeah, I mean, I think at some level of high profile, though, like think like someone like Elon, you can't control everything people are going to write or say about you, and so Elon's Elon, and he's going to have his fans, and he's accomplishing an incredible amount, both for his companies, for society. He's obviously going to have these critics. Most of the critics are going to be wrong, or certainly not as informed or successful as him, but he can't stop all of it. And I think like at some level of professional success, that's going to be true. So I think Peter has probably acknowledged that and just, insulated himself from caring.
Yeah.
It's why some people can be politicians and other people can't. If you go into politics, you're clearly going to be frustrated by what your opponent says about you, what the media writes about you. And if that becomes psychologically damaging to you, I think it's very difficult to engage in politics as an elected official. But some people, either relish it or certainly can tolerate it. And so it depends on the person a lot, their own psychographics.
Yeah. Yeah, I can't imagine relishing it. That'd be something. I think I'd just become numb to it.
I think certain people do relish it for politics, actually. Well, not without naming names, there's something.
Without getting into the election. Yeah. Segueing it to sort of just broader sort of like investment trends or maybe even like more specifically, are there any platform shifts you're particularly excited about or watching out for or sort of monitoring to see if it'll take off or seeing it as it takes off?
Not directly. As I said, I'm not a big macro thinker. I'm more of an opportunistic, this specific founder has a reasonable shot at changing the world, and I'm kind of going to join along for the ride and see if I can be helpful. Versus like I have some big hypothesis that the world is shifting this way and we need to jump on it. Once in a while, obviously with Open Door, I had this spark of an idea in 2003 about the world could be transformed in a very specific way, and that it was very feasible to do so. Similarly, I spent 2 years trying to fund a homeschooling company, publicly talked about it, publicly posted on Twitter about it, because I felt like there was room for a lot of innovation there and it'd be super successful. This is way before, obviously, COVID. So once in a while I have a spark, but that's not what I sit around and try to do is predict the future, as opposed to like try to find the most interesting people I can. So no, the one I do believe though, I will say on the distributed content side of the Substack to OnlyFans, and there's a spectrum there, that those are real trends. Those are not like one-off companies, that there's going to be a macro fragmentation of content and paid content along the lines we're seeing with just those two companies.
Yeah. And so would it look like? It looks like OnlyFans for X, or what does it look like?
Well, I don't know. I mean, if I knew, I would start it or whatever. But I think the decentralization of content and that people will follow and consume very long-tail content and pay for it. And that trumps the consumption of mainstream content or one large media, whether it's, a large Ford producer in the OnlyFans case or a large publisher in the, Substack case. But I think all forms of professional content, I think, are going to move to a distributed production where the economics flow directly to the creator. There are forms of content where the production costs and skill in producing is so high that may insulate it. But that was always the critique of YouTube, that no one would watch short form videos because you needed the fancy Hollywood studios to produce video content people would watch. This obviously wasn't true. TikTok took that to another whole level. So I think that you can actually scale down content, almost all kinds of content production, where at least the top 1% of the distributed world is producing content that people will subscribe to. But many people, let me put a fine point on this. There are, without naming names, people who would never pay for a porn subscription in a classic sense. They definitely are signing up for OnlyFans because they're following a specific person. And you just look at the metrics, like public metrics were like right after COVID hit, there was 200,000 new people signing up for a paid subscription on OnlyFans every day for a while.
Yeah. What about your? Remember, you were exploring goals.
Yes.
Feedback loops. Do you think that idea might you might consider?
There's still. I mean, it took me 10 years to get Open Door founded.
Yeah, totally.
So I'm only 3 years in on the goals app. So I've got plenty to go. If I cut it in half, so let's say 5 years is a realistic target. That'd be progress. Hopefully it'll be at least as successful. It should actually be more successful than Open Door. And in some ways it's easier, in some ways it's actually harder. But the basic idea is that, for those of you who haven't heard this before, is that there should be an app that's basically like a GPS system for your life. So if you have any goal, professional, personal, whatever. So I want to be a VP engineering. I want to double my salary. I want to get married. I want to look like a Men's Health model. I want to live 5 years longer. This app just tells you what to do. And if you follow it, incredibly can put you on a trajectory that has a high likelihood of success. And there's key common elements to each of those goals, and it basically assesses where you are versus the destination and gives you a plan and a program. And without thinking, you just follow this. There's been like narrow vertical versions of this. You can think of Future Fit, as an example of a very small, narrow version. But this is very different. This is broad, like I want to live 5 years longer, or this is exactly what I want to look like, or I want to date hotter people. It can be fairly vague. But so I've thought through many of the more difficult challenges in doing this horizontally and broadly, but I still need the right CEO. I think this is very specific. Getting this off the ground with the right credibility and the right breadth requires a very specific set of skills for the CEO. And so I know at least one CEO that I would definitely want to do this with. Like anybody else who has real talent, they have lots of options in their life. Sometimes they freeze too much thinking about it. You should see the number of people I tried to pitch on being CEO of Open Door. Like the list is very long. Many people probably should have done it. All these ideas are very controversial and seem insane until they work, and everybody's like, oh, well, of course. So I think the Goals app will be successful. If you look at a bookstore or book sales, the how-to section, advice, feedback, is always the best-selling section. The problem is books are written for everybody, meaning that they don't the bell curve, so they're not calibrated to you. There's a huge search cost to figuring out which book to buy or read or what chapter, what's credible, what's not. And this company should solve all that. Software is designed for compressing the feedback loop and customizing and personalizing. So this should actually be sort of a no-brainer. It's also universal.
Yeah. The investing and incubating path, is that a path that you would recommend more sort of like excellent operators, who also like investing consider? Or do you think it's even for, your proteges, JD Ross is in the building. Do you think it's unlikely, don't try this at home or something?
No. Delian's working on one right now. He's going to try one. We've had success at Founders Fund. Trey, my partner Trey, co-founded Anduril, which has done phenomenally well. So there's lots of people, Josh at Thrive has had success with Oscar, et cetera. So there's a lot of examples of success. I think the key is to recognize, one, the time commitment. It's severe. Number two, what is your unique contribution that continues? So in a capital-intensive business, actually it's pretty easy for VC to add value. Open Door constantly needed both debt and equity. So me being at the bleeding edge of raising money can be very useful to the company over years, because the company always constantly needs to finance itself. But imagine like a social photo sharing something. Once I'm the founder and once I set this off the ground with the core team, how do I continue to add value? And I think if you have equity as a founder where you don't continue to add value, regardless of whether your full-time job is a VC or not, there's going to be some frustration there. So I think it's not accidental that Oscar has a very capital intensive business. Opendoor has a very capital intensive business. I think those are better for VCs than where you can't see a continuing point of leverage for yourself as a VC. But there are ways to solve that too. But I would just factor that in as one more subtle ingredient. Mike Spicer has been phenomenally successful in incubating. I think part of the role of incubating that a VC can be very proficient at and is scalable is matchmaking, assembling a core team. So, in Opendoor, we had I had three co-founders, including JD. None of the others basically knew each other. So Erik is CEO, never had met JD before. I sort of introduced them. Erik nor JD, I don't think, knew Ian. And I happen to have a data scientist in my back pocket, which we really needed, that was ready to go. And so matchmaking is something a VC does all the time. We do this with our executive teams across the portfolio anyway. Company X needs a VP of talent, company Y needs a CFO, company C needs a general counsel. We're involved in sourcing, assessing, interviewing, and closing all day. So this assembling the core team for a complex business can be a very significant value creation step for a VC. I think the key is though that you have something you care a lot about, because it does take an irrational amount of time for the first, call it 1 to 3 years. And if you try to justify it on a pure short-term ROI basis, you would talk yourself out of doing it. When it works, it's great though, because you have proprietary deal flow. So you think about the reason why I did it was not because I was such a fancy thinker of I'm going to create proprietary deal flow, blah, 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 blah. The reason why I did it was I really wanted to get this off the ground. And as I was debating whether I should finally become a VC after 13 years, I kind of concluded that I probably should, or I would never really get around to doing it. But that I'd gone far enough down this path towards what we used to call home run that I needed to figure out a way to do it anyway. Fortunately, I was working with Vinod Khosla, who's very supportive of this kind of investing strategy. So I felt like I could sort of do the proverbial have my cake and eat it too. And so it was more that I felt that I wanted to do both and not compromise. And this was a path that made sense for me. Now, as I think about doing it again, it's more, I have an idea that I really want to propel into the future, and that B, it is a way of creating proprietary deal flow, which is a little bit more strategic as a VC.
Yeah. My last question is from the audience, then we'll get you out of here. If you did a bet, you've done a homeschool company, but if you did another bet in sort of education broadly defined in the next 2 years, what might it look like? What is potentially exciting to you within that space formally or even in adjacent?
Yeah, so education is interesting. I think the clear key criteria would not be selling anything to pre-existing institutions. I never want to do that. My whole investment strategy, you can look at my pinned tweet, but it's basically vertically integrated companies that completely replace something else. And so what I'd want to do is probably replace, higher education. If you think about the opportunity right now, I've always been somewhat interested in this. You can say I'm guilty by association with fancy degrees from Stanford and Harvard, but fundamentally that's also the reason why I realized that a huge fraction of the value, let's say, is the credential, not the actual learning. And the cost is, incredibly exorbitant. So, but one virtue of COVID is it's not going to be practical for universities to operate in the kind of default mode that they have been for, a century. And the economics are so starkly unaligned with the value creation, especially in a Zoom-based education world, that a lot of parents don't feel like they're taking risks with their children's future by trying alternatives. Speaking of Peter's brilliance, over a decade ago, he realized the ridiculous nature of the student debt, that we were basically piling on people and the lack of ROI there. So one of the reasons why he started the Teal Fellowship was to point that out and highlight it and magnify the difference. But I think now that's no longer a contrarian view. It's very consensus that this debt makes no sense. Yes, you could justify $60,000 for the Harvard credential, but it's irrational to have video-based education for $60,000 a year. And there must be both a more economically efficient model for educating people, but probably credentialing people, and certainly better from an ROI standpoint.
Yeah. And do you have a hunch for what it'll look like? Will it look like Minerva? Will it look like something totally different that totally online that we haven't seen before? Do you have a hunch?
Truthfully, I wish I knew. I really do believe that if I knew it, I would start it. I think the core ingredients, though, are the signaling. I would start, most people, especially in Silicon Valley, start with the utilitarian function of learning. And I would start the opposite way, which is the signaling and the credentialism. Because that's what people are truly paying for. They may not admit it. It's a little bit like buying a Porsche. You don't admit the reason why you purchased a Porsche. So I think that's what drives people crazy and misleads them. Or I would compress the feedback loop on the learning to show that I can create roughly a proverbial order of magnitude improvement in learning so that there's no doubt that I've innovated on the learning side. It can't even be a debate, or there's no way to cut through the clutter. So I would design from first principles to either be an order of magnitude improvement on learning, and I can back that up very quickly, or it has the equivalent signal, positive signaling, and I know how to create that brand halo right away and then fill in the blanks around those things. So I would fund either of those two in the hands of a good entrepreneur.
Yeah. Awesome. Yeah, we hope that's on deck. To be continued. Guys, this was really great. Keith, thanks so much for taking the time to chat with all of us. Virtual round of applause for Keith. Keith, thank you for joining.
Pleasure to be with you.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.